Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. Welcome to The Explainer. You know, every business out there, I don't care if you're a giant corporation or a tiny startup, faces this one huge question. Where do we put our money? Do we build a new factory, launch a new product, pour millions into advertising? Today, we're diving into a powerful financial tool that helps them cut through the noise and find a clear answer: the net present value method, also known as NPV. All right, so here's our game plan. We're going to start with the big investment question that every company faces. Then we'll get into the real heart of it, this idea that money today is worth more than money tomorrow. After that, we'll see how NPV gives us a super simple go or no-go rule. And then we'll put it to the test with two real-world case studies. And finally, we'll look at the fine print, the key assumptions you really need to be aware of.
Okay, let's dive right in. The fundamental problem is this. Imagine you're in charge, and you have a big pile of cash to invest. You've got several different options in front of you. They all look promising, they all promise to make you money, but they all cost different amounts and pay your back over different amounts of time. How in the world do you pick the real winner? And that question is way trickier than it seems on the surface, right? It's not just about which project makes more money in total. The real enemy here is time. $1 million you get back next year is not the same thing as $1 million you get back 10 years from now. We need a way to put them on a level playing field, and that is exactly what NPV was designed to do. And that right there brings us to probably the single most important idea in all of finance: the time value of money. It's a simple concept, really. A dollar today is worth more than a dollar tomorrow. Why? Well, think about it. You can take that dollar you have today, invest it, and it starts earning a return for you immediately. That future dollar, it's just sitting there, not working for you. So the big question is, how do we actually compare money from the future with money we have to spend today? We need a way to build a bridge between the present and the future. And for that, we have this toolkit called Discounted Cash Flow Techniques. They give us a clear, logical way to take all that future money and figure out what it's worth right here, right now. And the star of that show is net present value. Okay, so what is net present value, or NPV, really? At its core, it's actually pretty simple. It does two key things. First, it takes all the cash you expect a project to generate in the future and calculates what all of it is worth in today's dollars. Second, it subtracts the money you have to spend right now to get the project started. The number you're left with, that's the net present value.
But wait a second, how do we do that translation? How do we pull future money back to today? Well, that's where this magic number called the discount rate comes in. You can almost think of it like reverse interest. It's the rate we use to shrink those future dollars back to their present value. And this rate isn't just pulled out of thin air. It represents the minimum return a company needs to make on an investment. It's often tied to how much it costs them to borrow money, or what their investors expect to earn, plus a little extra to account for the riskiness of the project.
Okay, so we've talked about some slightly complex ideas here. But what's so cool about NPV is that it all boils down to one super simple, incredibly clear rule for making a decision. And here's the rule. It's beautiful in its simplicity. If your NPV is positive, even by 1 cent, or 0, that's a green light. The project is a go. It means it's expected to earn more than your minimum required return. But if that NPV is negative, that's a hard stop, a big red light. It means the project won't even clear your minimum hurdle, and it would actually destroy value for the company. All right, that's enough theory. Let's get our hands dirty and see how this actually works. We'll start with a nice, simple case study where the money comes in steady every year. Okay, picture this. A company's looking at buying a new machine. It costs $50,000 right up front, but it's expected to bring in $20,000 in cash every single year for the next 3 years. Now, if you do the quick and dirty math, that's $60,000 in return for a $50,000 investment, a $10,000 profit. Sounds good, right? But is it a good investment when we factor in that we need at least a 10% return? Let's find out. Now, because we're getting the exact same amount of money, 20 grand, each year, we can actually use a little shortcut. We don't have to calculate each year one by one. Instead, we can use what's called a present value of an annuity factor. Don't let the name scare you. Just think of this number, this 2.48685, as a special multiplier that's already done the hard math for us for a 3-year, 10% scenario. All we do is multiply our yearly cash flow by this factor.
So we take that $20,000, multiply it by our factor, and that tells us the total present value of all our future earnings is $49,737. Now for the final step. We subtract what we paid for the machine, that $50,000 initial cost, and what are we left with? A negative $263. And just like that, we have our answer. Remember the rule? A negative NPV is a no-go. So even though on paper it looked like we were making 10 grand, once you account for the time value of money and our 10% requirement, this project actually falls short. It would destroy a little bit of value for the company. The decision is clear. Reject the project. Okay, but let's be real. In the real world, things are rarely that neat and tidy. What happens when the money doesn't come in so predictably? Let's look at a more realistic case. All right, new project. The cost is the same, $50,000, and our required return, our discount rate, is still 10%. But check out the cash flows this time. They're all over the place. 10 grand in year 1, then 25, then 30. Now, if you add that up, it's $65,000 in total. That's way more than the last project, so this has to be a slam dunk, right? Well, maybe. It all comes down to when we get the money.
Since the cash flows are different each year, we can't use our shortcut anymore. We have to do this the old-fashioned way, 1 year at a time. First, we take that $10,000 from year 1 and pull it back to today's value. Then we do the same for the $25,000 from year 2. And finally, the $30,000 from year 3. Once we've got all 3 of those numbers in today's dollars, we just add them up.
Okay, when we do that, the total present value of all those inflows comes out to $52,270. Now for that final step, subtract the initial $50,000 cost, and this time, we get a positive number, $2,270.
And there it is. That's our signal, a positive NPV. Remember the rule? Green light. This project doesn't just meet our 10% required return, it actually beats it. It's going to create value for the business. So, what's the decision? Easy. We accept this project.
So you can see NPV is an incredibly powerful tool. It gives you a really clear answer. But, like any model of the real world, it's not perfect. Before we wrap up, we have to talk about the fine print, the assumptions that are working behind the scenes. Okay, so there are a few things to keep in mind. First, the model assumes all the cash for a year comes in on the very last day of the year, which isn't how it usually works. Second, it assumes that as soon as you get that cash, you can immediately reinvest it somewhere else and get that same 10% return. That can be a tall order. But honestly, the biggest assumption of all, the one that requires real skill and a bit of a crystal ball, is that your predictions about the future are actually correct. Because at the end of the day, the NPV calculation is only as reliable as the numbers you put into it. So what's the bottom line here? The beauty of NPV is that it boils a complex decision down to a single number, a dollar value that tells you if a project clears your required hurdle. And if you're looking at a bunch of good projects, all with positive NPVs, it gives you a fantastic way to rank them. The project with the highest positive NPV, that's your champion. That's the one that adds the most value to the bottom line. And this brings us to one last, really important thought. NPV is a fantastic tool. It gives you the financial answer. But great business decisions, well, they aren't just made on a spreadsheet. What if a project with a slightly lower NPV opens up a brand new market for you? Or what if it's a defensive move to block a competitor? Sometimes the strategic value is just as important as the number itself. The best leaders know that NPV is a guide, not a gospel. It's about using this powerful number and then weighing it against the bigger strategic picture. Thanks for joining us on The Explainer.